Hey, John.
Good afternoon.
Well, one of you looks like John, but the other one doesn't look like John, but you're both
I
showing up as John.
it did this to me last time.
You wish
we're both
you
John.
you wish you were me.
I
John
do
1 and
sometimes.
John 2.
Oh,
All
he's definitely smarter.
All right. Well, we got a bunch of people are still getting on here. Let's see if we can get the screen sharing over to you guys. John, are you driving?
Yeah, let me do that now.
Oh, got some stereo going on.
How did we get two Johns? Three
Um,
Johns.
Three Johns. I thought one of you was enough, but apparently,
Amanda, are you in twice?
Oh, hold up.
okay. Now we just got two. Go ahead and talk again.
Okay, here we go. Share my screen.
Yeah, it's still happening. Holy mackerel. Thank you, Frank.
I don't know if I should I go out and come back in.
Yeah, something's wonky. I'm not sure what it is, but we're hearing you twice every time you talk.
All right, I'm gonna go out and come back in.
Okay, sounds good. Everybody stick with us here. We'll get John back in a second and we'll be off to the races. In the meantime, Melissa will sing.
Right. You don't want to hear that.
No,
Hi, Amanda,
I do.
Hi.
my bestie.
How
You mean
are
John
you?
Gibbons?
Yes.
I'm apparently John today.
Yeah. Stick with us, everybody. We're gonna have we're having a slight technical issue, but we'll get John back here momentarily and we'll get rolling. So
How do we kick this other John out?
let me see if I can get rid of him.
Okay.
I'm gonna try to remove John. If I get rid of you, Amanda, I do apologize in advance.
That's okay. Oh, you kicked the Phantom John out. That works.
Okay, let's see if the real John gets back in now.
Will the please real John or the please stand up? Is that the Slim Shady song, I think? Oh, let's see if the real John is coming back with us.
He's getting there.
All right, how we doing?
We can hear you. We can't see you, but
Yep, we're
I
getting
mean, we can
there.
see you, but we can't. Now she's corrected it. So
All right, why? Oh, my camera on now, right?
No,
not
not
yet.
yet.
Because my light is on, like the camera is working.
Well, there's a
Go.
joke in there somewhere. Thanks for everybody's patience. We'll get you going here momentarily. We're just figuring out a little technical thing. And if we have to go without audio, John, no big deal. Or without video rather, no big deal. But let's see if we
Yeah,
can.
I like it better if I can. This is weird. I have a workaround. I could go right through my laptop, but
Yeah, in the interest of time, maybe just, I know you'd rather go with video, but if we got to go with audio only, let's make sure we can screen share though. See if you can get the screen
okay.
sharing on. Let's make sure that's not causing an issue. This is the entertainment portion of the webinar, everybody, just so you know.
Melissa didn't want to sing, so we get John's entertainment.
It was the best we could do. All
Oh,
right, there you
there's
go.
Yay.
John is
Well,
sharing. Now
now
we see
we can see your
John.
camera now.
Okay, cool.
Now we can only see your camera. So we're seeing your screen. There you go. So
Yeah.
you must be running dual screens.
There we go.
Yeah.
Hey, at least
Got the
we got
slides.
there we go.
Well, we'll go with that.
Perfect.
All right. Well, thanks, John. Appreciate it. Thanks, Amanda. Good to have you with us here today
Absolutely.
as well. Melissa, good to see you. And good afternoon, everybody. Um, Wanted to welcome everyone today for part two of the three-parter that John and Amanda are doing for us for Mutual of Omaha. And it's a kind of a logical progression kind of thing. John laid that foundation for us last week, and he's going to build on that here today and talking about, hey, what are some common sense designs for various plans How do we integrate the design of those plans into making sure we've got a clear understanding of product in that context as well? And this is once again kind of our effort this month to really get the word out as it relates to long-term care planning and the role that the various long-term care insurance products can play. So we've got these 3 sessions, and then we'll switch things up a little bit and have a little different approach when we talk about long-term care insurance for high net worth folks as we finish up the month of April and push into May. And so we're going to really have a long-term care driven month here for the month of April, and hopefully everybody benefits from that. The other reason that we decided to do it this way and focus on this in April and even take it into May is to lay the foundation for our long-term care carrier days, which I know some of you, because of geographic reasons, won't be able to join us for those necessarily. But those of you in New York and Pennsylvania, Eastern and Central Pennsylvania in particular, hopefully we'll see a lot of you at those sessions. They have been very popular. Been a couple of years now since we did it, so we're back and better than ever. And John is going to be with us for most of those, as I recall, and we'll look forward to seeing him there. Amanda, I don't recall if you're joining us or not, but those should be great meetings. Melissa and I will be out on the road and be seeing all of you during those as well. So again, I'll leave it at that, other than to mention a couple of housekeeping notes. We're recording the session as we typically do, so that if you need to revisit things later on, if you want to share the recording with a colleague, you can do that. We encourage you to do that. Once it's recorded, we put it up on our website, advisorsib.com. So that's advisors with an ORS at the end, advisorsib.com. Just go into tools and resources, and then we have our archived training, and we have all the past webinars that we've done over the last probably year and a half housed out there, and this will be added to that here in the next couple of days. So we also have the lines muted. I don't think this is anybody's first video webinar Zoom meeting rodeo, so no surprise there. We want to make sure we get rid of any background noise. However, if you do have questions, you can go ahead and type those into either the chat or the Q&A. I'll be keeping an eye on both of those, but preferably the Q&A panel. So if you have questions, I would encourage you to put them in there, and we'll make sure that John and Amanda get to those before the end of the presentation today. So John, with that, hey, welcome back both to you and to Amanda. Great to have you here. And with that, I'll go ahead and turn it over to you, and the floor is yours.
All right. Good afternoon, everybody. If any of you are new to New York long-term care, you're in the right spot. All right. You've got Bob and the team, Melissa leading the long-term care team are just superstars. I mean, they're great across all product lines, but very seasoned and have all the products for long-term care. You're in good shape there. So today we want to talk about the long-term care conversation. As Bob mentioned, we set the stage with LTC 101 in the first of this trilogy. And then today we want to talk about how to have the conversation and sales ideas and the risk involved and things like that, and why to be proactive, and give you the tools to have the conversation with them. My pet peeve over the years has been doing this for 25 plus years. Most agents, advisors are not proactive. And sometimes when they are, they just go to Melissa and Jen and get an illustration. And all they do is walk through the illustration. And then the client says, you know what, that's too expensive. And you blame the carrier because you didn't show any value. You didn't tell them why they needed it. So I'm going to give you the tools today to do that. I encourage you to take copious notes, write these things down. And then next week, we're going to talk about how to craft an illustration and how to design it. And I typically drop it into 3 buckets, middle class, upper middle class, and affluent. And we'll get in depth on that. So let's talk about the LTC gap. All right, first, why there's the need. On the left-hand side, greatest financial worry in retirement. You're asking retirees and pre-retirees. And the number one answer was not what most people think. It was not outliving my savings. It was healthcare cost, including long-term care. 52% retirees, 66% pre-retirees. This is a concern. Number one concern. Now, let's look at the disconnect and the gap. So this is a LIMRA study, second bar chart here from the left, right here. In blue, I need it. 55% saying, raising their hand, I need this. In the orange, 15% say I have it. That's the biggest number I've seen. That number is usually 10%. All right. 15. But all these people are saying, I want it, I need it. And I believe, with all due respect, is that advisors, agents are not positioning correctly, or not doing it at all. In some instances, the opportunity is here. Now, let's talk about the cost. We touched on this briefly last week. I'll do it again as a refresher. We were talking about nationally around 113,000 for a nursing home, 70,000 here for home care, and 65 for, and again, these are national. A lot of you are going to be in the Northeast. New York, New Jersey, Connecticut are more expensive. I get that. But just to ground you a bit, so on our SPA, our sales professional access, you have the opportunity where you could go in there, click on the drop down, pick New York, New Jersey, whatever, and pick, hey, how much is this going to cost 25 years from now? And here's why you would do that. The average person who buys long-term care is around age 56. The average claimant is age 80, and I encourage you to write that down, age 80. Well, then why am I buying it at age 55, 56? Because you want to buy it while you're young, while you're healthy, and it's less expensive. All right? And the big one being, one, less expensive, but also the risk of uninsurability if you wait. All right? So what you can do here is show somebody, hey, here's the cost and the risk to your portfolio 25 years from now, 252,000 a year. 25 years from now, 155, whatever the years from now. So that's the key. Think about utilizing this. All right, now we're going to talk about self-funding, self-insuring. Some people go, hey, John, I'm going to self-insure this. Well, you're not insuring anything. You're self-funding it. All right, so that means you're rolling the dice. It's a gamble. You're saying, you're guessing that it's not going to happen to you. And guess what? That can be an all-in bet. And that's what's happened to many people. They rolled the dice and they went through their whole portfolio. Over the years, I've had numerous people come up and say they went through $2 million. Some say, hey, we went through it all, whatever that number is. The most I've heard, which was literally like 20 years ago, was like 5 million. 2 years ago, I was on a panel and somebody said 4 million. That's the reality. That's the risk they're taking. My mother had MS for 40 years, was in a wheelchair the last 20 of that. My father had to be the caregiver. We couldn't get her long-term care. She had MS. So he's the caregiver. He passes away. We run out of money eventually. She ends up on Medicaid in a nursing home facility. All right. When she passed away a few years back, I did back of the envelope math. She easily been a $2.5 million claim. Easily. That's the reality. All right. Now, a policy protects you, transfer the risk to ones you love. It's preventing your spouse, adult children from being, don't do it because they love you. They'll be the caregiver, but you think they want to? All right. So let them manage the care, transfer the risk. Let them manage the care so they can be a son or daughter during these difficult times. Here's the other one. If you spend down your assets, let's say it's me, and I get whatever, dementia, ALS, Parkinson's. I'll tell you, why I think about it. Dementia, average life expectancy is, I think it was 9 years. Parkinson's, I believe, was 12.5 or something like that. MS is like 22 years. Long tails on those, right? So I get, and I need care. and I go through all the assets or a major portion of them, what's my wife going to do? Is she going to go back to work at age 90? So something you got to think about. Here's another thing I mentioned, if somebody's pushing back and talking about this, and you don't think they're grasping the brevity of the concern here, the risk. Ask the question, Mr. and Mrs. Jones, if you had an event a year from now, 3 years from now, which assets would you liquidate first? And shut up. Don't say, how would you pay for it? Don't ask, what would you do? The key word is liquidate. Because now Mr. Jones is going to go, whoa, time out. We just worked the last 40 years for this. We're not liquidating anything. That's we did this for our retirement. Well, if you have an event, how are you going to pay for it then? You've got to liquidate something. And then Mrs. Jones is going to go, whoa, time out. We're not liquidating anything. If he liquidates this, what am I going to live off of? So it's a great way, and I'd write that down to have that conversation. All right, so what happens when there's an event? It's a fire drill. Because, as you saw, most people don't have a plan in place. They don't want to have the conversation, or they haven't had it because the agent didn't bring it up, advisor. So what happens is stress levels go up, emotional competency goes down, irrational decision making. And then one of the adult children may have to step up. I'll go work part-time or whatever it is. So then what happens? You take that healthy son or daughter, and because of the stress and everything associated with being a caregiver, they become unhealthy. And then we have to move mom or dad into the nursing home. Statistically, if I don't have a policy, I believe it's a 40% chance I go to a nursing home. If you have a policy, it's like 13% only nursing home. The care is given at home. All right. Because the caregiver gets burnt out, you just replace the caregiver. So here's what happens. You got to this is a study from Rethinking 65, the financial strain. Families without transferring the risk experience more severe financial consequences. Many had to retire early, reduce their hours of work, had to pay for some of this, right? Families that did have it were very grateful and used the term life-saving. Someone said it was costing them over $100,000 a year. So how do people pay for it? Well, when they don't plan, you're using your personal savings, assistance, family and friends stepping up and being the caregiver. Enter the Medicaid program. Like my mother, we ran out of money. Where you transfer the risk. And this is, something like this is a good way to just lay it out for them. Here's your options. So when you're talking to them, what I've noticed is the top advisors try to stay away from talking even about insurance. They just keep talking about a plan. And it may or may not include long-term care. It may not include insurance, but you're going to hear, Mr. and Mrs. Jones, you have numerous options. One is, this, and this. Write them down and speak to them. All right. But a lot of the good ones never mention the word insurance. They just say an option is to have this covered or have somebody pay for it. They don't say, hey, buy long-term care insurance. Assistance for family and friends when you don't plan. And here's some statistics. And you can take a screenshot of this or a picture of it. But when you do this, do not use statistics to scare people. All right, use the statistics as more matter of fact to reinforce things, and that's important. Back in the 90s or whatever, 20 years ago, 30 years ago, that's what everybody did, was scare tactics. No, just lay out a plan. All right, have a conversation. So 61% of families paid for costs of professional home care. 63 paid with money from their retirement. So it'd be like if I had to pull money out of my retirement to take care of my parents. 48% said it reduced their quality of life. 42% stopped contributing to their savings. Missed time from work, worked fewer hours, on and on. That's the impact this has on a family that they need to understand. That's why you have to have the conversation. You have to set the stage for this. So now let's talk about a sales track. Most people are like, I don't know where to start, where to go. So one of the first things I would do before you start going through statistics and things like that is do your pre-underwriting, so you're not wasting your time. Make sure they're healthy, because you want to go through all this and all of a sudden you're going through an application, you start asking health questions, and I was diagnosed with MS a year ago. I don't have symptoms yet, but I have it, or I have some, but I'm good. That's a problem, right? So, and here's the thing. Over the years, I've heard people say two things about long-term care insurance. One, it's hard to get and it's very expensive. Wrong on both parts. Okay, it's not hard to get. We approve we decline only 18% of our applications. That's it. 18%. All right. And if you do your field underwriting, the ones that do this all the time and are good at it, their placement rates are like 90% stuff. So, and here's the other thing real quick while we're on underwriting is we changed our methodology and how we do our underwriting kind of with technology and stuff about 2 years ago, where our underwriters can pull up on their monitors medical coding. So there's an 88% chance John Gibbons is in this database. And they can see medical coding for me when I've been to the doctor, this or that, telling them any issues and stuff. That has helped us reduce the number of medical records we order by 40%. 40 less. 40 less phone interviews. So if somebody is below age 60 and they're healthy, we waive the phone interview, we waive medical records, they're probably approved in 4 days, out the door in 5 or 6. That's the new era of cycle times with us. Our average cycle time is 30 days. All right. The days of 90 days to get medical records and get you a policy, those are the one-offs. Those are the exception to the rule. So it's a better experience now. All right. Next, needs analysis. Know who you're talking to, even if it's just your client. I put it in 3 buckets: middle class, upper middle class, and affluent. All right. And you design accordingly. And Melissa and the team are great at doing that and how to do that. And we're going to discuss exactly how to do that next Thursday on the call. We'll be crafting an illustrations. But just you have to design it appropriately. It's not cookie cutter. I'm not going to show a middle class individual the same thing I would show an upper middle class. If I do that, what's the middle class person going to say to me? I can't afford that. And they got nothing. All right, we'll get to that. Different plan options. They have everything at their disposal. Traditional long-term care, asset-based life to the rider. We have a great IUL with a long-term care rider. So you have numerous options. We'll get our fair share. If you want to really get good at this, is kind of understand the product and all the ancillary benefits. All right. Like care coordinator services we talked about last week, like the concierge service. You can get bed reservations, home modifications. There's all these different things that are with the policy. When you build these up, then the people see the value. All right, so let's talk about having the conversation. Here's the thing. This is an emotional sale, not logical. Oh, you've done your field underwriting. You know what demographic they're in. So you want to have a conversation and a dialogue on the importance in laying out this plan. So you can ask these questions down here. They're okay. They're not bad. Mr. and Mrs. Jones, if you needed care, where would you want to receive it? And they answer that. Now, if you want to, who do you want to provide it? And it's not going to be their adult children. If you need care, how would you pay for it? All right. So this starts a dialogue and a conversation, which is going to help you to close. But next slide here, please write this one down. This is the one I like the best. Mr. and Mrs. Jones, do you have any experience being a caregiver? And if the answer is yes, so I'll let you write that down. Have you had any experience being a caregiver? If the answer is yes, what was the impact to you physically and emotionally? And shut up. Because I guarantee it was a nightmare. Anybody on here, I know there's many on here that probably had to do it. It's a nightmare. You want to bring that out and stuff. And you're hoping they're going to go, yeah, it was this. I had to go to my mother's house 4 nights a week and make dinner and put her to bed and whatever. Or my mother moved in with us for 2 years and blah, blah, blah. And you're hoping at some point they actually go, and I don't want my kids to have to deal with that. Bingo. If you get any pushback in the close, you're going to use this information there. All right. If the answer was no, I haven't had experience. Now you want to tell them why you have a passion for, I like to use the term, I have LTC planning here. It should be extended care planning. Mr. and Mrs. Jones, you have any experience with this? I have. Extended care planning is critical in retirement planning. My mother had MS for 40 years, blah, 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 was in a wheelchair for the last 20, ended up in a nursing home on Medicaid. All right. If you don't have a story, get one. The more adamant you are that this is important, the more likely they are to protect themselves and transfer the risk. All right. Now, after that, here's the next thing I would do. Here's part of your sales track now. I'm going to give you a 3-step sales process. This is the most important thing, in my opinion, that I could teach anybody. All right. This makes the sale self-evident. And it's very simple to do. So I've just done the caregiver question. Mr. and Mrs. Jones, my most prudent clients work with me on extended care planning for 3 reasons. You may want to write that down. Mr. and Mrs. Jones, my most prudent clients work with me on extended care planning for 3 reasons. And you can see the 3 there. Screenshot it, write them down. I'm going to go through a slide for each one of these. So people are living a longer life. It's a family issue. And how will you pay for it if you have an event? So let's look at the first one. People are living longer. They'll get this, right? They know that their parents or people around them are living longer. So Mr. and Mrs. Jones, but advances in medicine, things that were fatal to our parents and grandparents are now manageable. Cancer, sometimes they're catching it pre-stage 1, or advances in chemo, people are living through it. I have a heart issue. What do? They throw a couple of stents in and send me back to work. No big deal. All right. So then you can ask this question, Mr. and Mrs. Jones. So you lived to 90, 95 years old, and just because of aging, you need help with bathing, dressing, eating. It's just aging. What's your game plan? I don't have one. That's why I'm here. We're going to lay one out. We'll figure it out. Or the other thing is, you're people living longer because you lived through these ailments. Now you're predisposed to get Parkinson. The longer you live, better chance you're going to get that, and dementia, both with a long tail on them. Have the conversation. All right, next. Mr. and Mrs. Jones, this is a family issue. All right, now before I get into that, let me go to this bullet point down at the bottom here, and every carrier uses this one. If you hit age 65, there's a 70% chance, 70, you're going to have an extended care event of some type, some nature. Don't know how long, but some nature. Now, if you think that number is wrong, cut it in half. 35% is still pretty significant, isn't it? Something that should be addressed. Now, that 70% number, if I'm talking to a couple, that extrapolates to 91%, 91, that one of you two, Mr. Jones, is going to have an event. Okay, and if they're pushing back, we think you're going to be one of the 9%? Now, let's talk about the family issue. So here's the thing. Families are smaller nowadays. 2 to 3 children. You mentioned you have 3 children. And here, please write this question down. It's one of my favorites. Mr. and Mrs. Jones, if one of you got ill, do you think all 3 of your adult children are going to raise their hand and help the same amount? And they're going to go, oh my gosh, I've seen it. They go, oh my God, I didn't even think of that, John. It's brilliant. Mary's the oldest. She's an attorney. She works 60, 70 hours a week. She can't help. John, the middle one's a guy, and he lives a little bit further away. He's not going to step up. It's going to fall to Susie. Okay. Do you think Susie's going to have a problem with John and Mary, whether it's justified or not? You better believe it. And here's the term I use. This tears families apart. And there's a good chance they're going to know somebody that happened to. And they're going to get it. I went through it in an extended family of ours, where we had relatives where 2 siblings did all the work, took care of mom. 2 siblings lived nearby, didn't even visit mom, much less help, for like 5, 7 years, 6, 7 years. One of them visited once, the other one never visited. They don't talk. That's what happens. And they'll get that, all right? This is the emotional part. Third, if you have an event, how are you going to pay for it? So you can talk about self-fund like we did in the beginning. And if you do, you're gambling, rolling the dice, and it's dollar for dollar. All right? If it's a $300,000 event, that's $300 of your money. You hope that's all it is. If it's $1 million, it's $1 million. If it's $2 million, you rolled the dice, you lost. All right? Here's another thing to think about. In retirement, statistically, it seems like a lot, but you're going to hit 4 bear markets. And the average bear market is down 30%. So, Mr. and Mrs. Jones, I want you to think about this. You're in retirement. We're in a bear market. Your portfolio is down 30%, and you're pulling that 4% out, or whatever that magic number is, that 4% out, and you can't sleep at night, wondering, God, the market's down. How long is this going to be? Killing my nest egg. Now, let's layer $100,000 or $200,000 extended care event on top of that, pulling from your portfolio. How are you going to sleep? How about we take that off the table? Transfer the risk. Next, family support, Medicare, Medicaid. Now, you don't have to be an expert at this, and I would stay away from it unless you are. Stay away from getting into the weeds. All I would say to somebody is, okay, and here's why you have to bring this up. Because I think statistically, it's like 68% of the people think Medicare pays for this. I get this in my neighborhood, upper middle class neighborhood, and tell them what I do, and I go, I thought Medicare paid for that. I'm like, oh my God, no. 100 days, then it stops. All right, so you got to let them know that. Medicaid, it's Medicare, be clear. Medicare, 100 days, stops. Medicaid for the indigent. Bring your assets down under $2,000 in most states, and you can go on Medicaid. All right, that's what happened with my mother. We ran out of money, but she ended up in a nursing home. All right, and the last piece of this is, in this planning is, there's ways you can just transfer the risk and have this covered. And that takes you right to the illustration. If you follow these 3 steps, you can have them written down in front of you. There's no shame in that. So, Mr. and Mrs. Jones, here's what I have found are the important things, and go through it. And you're going to have a dialogue. And they'll talk. You want them talking. All right? It handles all the objections. I've seen it. All right, let me take a pause there. This doesn't usually lend itself to questions, but any questions yet, Bob?
John, there was basically just one so far about the slides, just so everybody's aware. Yeah, John will share the slides with us and we'll share them with you. So in case anybody else has that question, yep, they'll be provided.
Okay. All right. So what happens once they say, hey, yes, let's take care of this issue. Let's transfer the risk. I'm going to do a policy. You'll see it in their body language. Anybody that's done it, it's like you see a relief that their biggest concern is taken care of. I've seen it. Now the clients have an action plan. They can choose to stay home, maintain their independence, protect income and assets, avoid depending on family members. It's a big deal. And because of that, it's a good time to ask for a referral. Hey, I can see you feel really good about this, as you should. Do you have other family members, coworkers, neighbors, or whatever that you think, would be interested in this and should transfer the risk also? There you go. Here's what I was talking about too. This is not a Mutual of Omaha statistic. These were when I was at One America and Genworth lined up the same at one point. 74% claims are at home, 13% assisted living, 13 in the nursing home. This keeps you out of the nursing home and at home where you want to get care and most people want to be. You want your care in a nursing home, you can get it. It's covered. But typically you want to be at home. All right, this is a document that somebody in the industry uses that allows me to share. And this individual only does long-term care. And he positions this as more holistic planning. All right. And just long-term care is just a piece of it. All right. And we'll lay out a plan with them. All right, Mr. and Mrs. Jones, we need to have a plan. And do you have your durable power of attorney? Do you have your healthcare directives, revocable trust will dated and whatever? And just having a regular conversation, more holistic. And then just segue to, all right, another piece of this is what would happen if one of you needed care? How would you pay for that as part of this discussion, right? And now follow the sales track we just went into. Here's something too that, I saw that I thought was interesting, and you could just draw on a piece of paper with them, say, you have options. You have a claim, you can go up here and you can use your IRA money, qualified money, pay taxes. You can sell stocks, non-qualified things, pay taxes. You can go cash, dollar for dollar then. Or down here, this bucket is you transfer the risk. And it's costing you only 30 or 40 cents on the dollar because of leveraging. It's a great way to paint that picture. Drawing it out, straw bucket, write it on there, right? And you can see at the bottom, by transferring the risk, again, as I had mentioned earlier, let them supervise the care, not provide it. All right, I'm going to go through this just to give you an idea of an impact. And my graphics aren't the best. I created this. So, and I did this a few years ago when we were in a bear market. And let's say a client had 750,000 in there. All right. At the time, the market was down 20%. It didn't hit the 30 yet at the time, but it was down 20%. And here are my assumptions at the bottom. That home care was costing around $62,000 a year. Now, if I'm using qualified money or money I have to pay taxes on, and if I'm in the 25% tax bracket, I'm at $82,000. I have to take out, not 62. If I'm in a nursing home, I used 113, but I had to take out 151. All right. So I had 750,000. 20% drop. I'm now at 600,000 in my pool here in the blue. I have 1 year in the nursing home. I'm sorry, 1 year care at home. All right. Now, I'm at the 600,000. The bear market went away, but I'm still at 600. It's just, I'm still at level. I didn't get my money back yet. Didn't grow. At home care 1 year at that 82,000 or whatever, but I actually got 10% growth factored in this. I'm now down to 517,000. Now I go to nursing home. 1 year in a nursing home, I got growth. I'm being very aggressive with growth here, 10%. Second year of care, I'm down to 402. Second year in a nursing home, third year of care, I'm down to 276. Fourth year of care, I'm down to 138. I pass away. That's what's left for my wife, 138,000. It would take her 18 years at 7 consecutive years of 7% growth to get her back up to 750,000. That's the impact to an estate. So that's something you could kind of draw on your own and, cut to the chase and just use a couple slides. All right. I'm getting near the end here. As I mentioned earlier, you need to have a story. If you don't have one, here's a good one. This kind of summarizes why this is important. This is an agent that is one of the top long-term care specialists in the country, does speaking for CLTC. He has a client. They had a policy. The husband gets dementia. The wife would leave the house to go get groceries or a cup of coffee with a friend, come back, and had fallen. One time he had lacerations on his head, another time he cracked ribs. So she calls him up and says, "Hey, don't we have a policy or something?" He goes, "Yeah, let's review and let's see what's going on." He goes, "I'm fairly certain, Mr. Jones, you qualify to get help and have help come into the home." He says, "Well, I don't want anybody to come into the home. I don't want anybody to help me. My wife can take care of me." And he explains, "Mr. Jones, with all due respect, this has nothing to do with you. Your wife is basically a prisoner in her own home. She can't leave the house, just even get a cup of coffee or something, without you getting hurt." And they turn and look at her, and she's got tears running down her cheeks. And he got it, understood it, and they used the policy. That's what this does. This is important in retirement planning. All right. This was one that one of my counterparts found. It was just, actions speak louder than words. Thought it was interesting. Just shows mom and dad walking Junior down the street, and then, 80 years later, it's reversed, right? Junior is now trying to help them down the street. And many advisors, like here, this bullet point right here, avoid this conversation because they're too worried about their investments and retirement portfolio rather than talking about helping them. All right, with that, this is the last slide. And I mentioned this last week. You just invested what, 40 minutes, 45 minutes of your time. Hopefully you got some golden nuggets out of that. I mean, you've got your three-step sales process. You're set. You know how to have the conversation now. There's your elevator speech too, the 3 steps, right? Mr. and Mrs. Jones, you're at a cocktail party. Why is it important? Well, because people are living a longer life, and this is a family issue. It impacts the entire family. But anyways, call to action. Your book of business, age 50 to 65. Look at there, and that's where you start. All right, you can go above and below that, but that's where I would start in the sweet spot. I would now go to business owners in that sweet spot. And we talked about this last week, the tax favorability for business owners. It's huge. Should be a no-brainer for them. All right. And then I look at single females at 60s and 70s. I guarantee you they're worried about this. They don't know they can get it. And then the wealthy clients. Wealthy clients will do this. All right. Some will summarily shut this down. But many of them understand the concept of other people's money, pennies on the dollar, and leveraging. And I don't know if I mentioned this last week, but I helped a couple like 20 years ago with a $40 million net worth. 40 million. And the mom had been into getting care at home for 10 years, had now was in a nursing home 20 years ago at $100,000 a day, a year in Tennessee because they knocked a wall down. She had 2 rooms, so that's why it was that expensive that long ago. And the adult children bought policies. Could they have self-insured? Absolutely. You're not going to go through 40 million. You're not going to put a dent in it. They understood the concept of leveraging and pennies on a dollar. And guess what? 2 years ago, the agent called me and asked me if I remembered the case. I said, absolutely. One of them just went on claim. Well, it went on claim 2 years ago. Smart business decision. We had another one where the guy was 50 million net worth, and that was a Mutual of Omaha case. The other one was Genworth. And again, asked him, this was a few years ago when I first came here. And so they asked him, why'd you buy it? He goes, I'm not so sure if I needed care that my adult children would ensure I got good care. They might be more worried about the money. So he bought a policy. And then one last one for wealthy was lady had like 7 or 8 million, a couple, self-made in real estate. And they bought a policy and the agent asked, why'd you buy it? She said 2 things. One, my husband does not take good care of me when I get ill. But the main one is, why would I give my money, hard-earned money, away to the healthcare system when I can transfer the risk and get better leveraging? And use Mutual of Omaha's money? Why would I use my own? And that story is actually 20 years old also. Never forgot it. Why would I give my money away to the healthcare system? So you got a wealthy client says, yeah, I can self-insure. Why would you? Why give it away? All right, with that, the main thing is be proactive, not reactive. Be proactive. We pay commissions too. All right. I know you're doing it for benevolent reasons, but we do pay commissions. And with that, think about over the next 2 weeks, which clients, prospects you're going to speak with, and get with Melissa and her team, and they'll craft an illustration for you and start the conversation. With that, Bob, I'll throw it back in your lap.
All right, John. Thanks. Great job as usual. Thanks, everybody. Additional questions. Now is your opportunity. So many great points that John brought up. You know, he's been doing this for a while, and you can see why he has been so successful at it when he's got the great perspectives that he brought to us today. So thanks again, John. Really do appreciate that. And I agree. I don't think we can overstate the importance of being proactive. Study after study and survey after survey have shown the importance of it, and the fact that when you ask people, you know, who initiated the conversation, a little bit too often it is the client or the prospect who is initiating the conversation with the agent or the advisor, and we need to flip the switch on that. And we need to do a better job as an industry of getting the word out there, especially when we have these situations. John alluded a little bit to Medicare and Medicaid, and look, there's so much uncertainty with regard to what those public funding mechanisms are going to have available. Look, we know that Medicare does not pay for long-term care, true long-term care, that is. Medicaid certainly does pay, but what's going to happen as we go into the future? Budgets are under such a high degree of pressure that the thought that Medicaid will be able to either maintain, let alone improve, what it's paying now is kind of a fool's bargain in my view. So important that each of you are getting out there and having the conversation. And John's absolutely right. It's not expensive and it's not hard to get. You just got to do it the right way. And that's why Melissa and Jennifer are here on our end to make sure that they craft the right policy for you, the policy design for you, and so forth. So John, good stuff as always. Last chance to ask questions, gang. Melissa, I want to have you chime in. Anything in particular you want to add for the discussion or share with the group?
Not particularly, John. I've obviously seen your spiel, your presentation about having the conversation, and we are very, very in line, together. That's really the way that I present it as well. I always joke that it's really not about the quote and the riders and the benefits and the product. It's about the need. Long-term care is an emotional needs-based sale, And if you can't help them, visualize that there's a very good probability that they will have a long-term care event, not if, but when, more so, that our quotes could cost a nickel and no one's going to buy. So it's super important, that you take some of John's tips. We're going to have further discussion, about long-term care planning at our Carrier Day Roadshow. So hopefully, if you're in the New York, PA, New Jersey area, and you can join Bob and I and John and our other LTC and linked benefit carriers, we would love to have you. But with that, I guess I'll just leave it at that. I'm sorry that I won't make it, John and Amanda, with the third leg of this this webinar series next Thursday, as I will be out. My son is getting married next week. So I apologize that I won't be here for that, but I know you'll be in very capable hands with Bob at the helm. So thank you for doing that. And thank you for all those that have attended. And these are all recorded and they all will be available for playback up on our website within a day or two for sure.
Thanks, Melissa. And as mentioned, once John gets the slides to me, we'll go ahead and share those with everybody who is registered today. Amanda, I want to give you a shot as well. You've been very patient, giving John the floor. Anything in particular you wanted to add to round out the things that John shared?
Oh, no, gosh, John knows it all. I will not be joining John on his travels, even though I love the idea of meeting Melissa in person. No, John really covers it all. And if anybody needs any assistance besides reaching out to the NYLTC team, me and John are here for anything that they're not helping out with.
Well, appreciate that, Amanda. John, I'm going to give you the last word before I give one final check for Q&A and get us the heck out of here. Anything you want to wrap up with?
I'm just going to say I can't reinforce enough how to just use those 3 steps when you're having the conversation. It'll give you a dialogue and conversation that you'll be able to help guide them on the importance of this. And with that, again, be proactive. And thank you for your time.
All right, John, appreciate that. Barbara did have a follow-up. We can connect offline on that, Barbara, but Barbara's question was, I believe we have the option of selling the plan, but also having you take care of it and we receive a commission or compensation. Short answer is yes. We've got a couple of different models there. We can connect you either with Melissa or a producer where they maybe specialize in it. If you have, you don't necessarily have as much desire to do it directly, but you want to be able to share in the compensation. The short answer is yes. We have a couple of different models that we can certainly help you with in that regard. I would encourage you to touch base directly with Melissa on that. She kind of captains that effort and she'll be glad to help. So appreciate that question. And no other questions. Sure thing, Barbara. No other questions. So with that, I'm going to go ahead and wrap it up. Hey, we had a great turnout. Thanks everybody for being here today. Have a great week. We'll be back in the third part of the trilogy with John next week. And we'll look forward to seeing everybody then. So take care, everybody. Have a great rest of your week and beginning of next week. Have a good one.
Thank you. Take care, everybody.